headlines are screaming record highs, but a 219% warning sign is flashing. The US market is playing with fire. Look, when Warren Buffett packs his bags and sits on $382 billion in cash, you don't stay at the party, you find the exit. Is the indicator broken or is it a siren? Today, we run the S&P 493 extraction to see if this market is a bargain or a trap. Let's dive in. To understand why investors are sweating, we need to put this 219.4% figure into perspective. Imagine the US economy is a giant steam engine. It's chugging along, producing goods and services. Now, sitting on top of that engine is a pressure gauge, the stock market. Right now, that needle isn't just in the red, it's vibrating so hard it's about to fly off the wall. Historically, this gauge is used to measure the total value of all public companies against the size of our GDP. At 219.4%, we are far above the dot-com peak of 142.9%. Think about that. In the year 2000, we thought the world was ending because valuations were so high. Today, we've essentially doubled that historic disconnect. And check this out. Warren Buffett's record $382 billion cash pile suggests he isn't waiting for the party to end. It looks like he's already called his Uber and left. He's rowing a lifeboat labeled cash away from a sinking cruise ship. If the world's most famous buy-and-hold investor is choosing a savings account over the S&P 500, it sends a loud signal. Is he seeing a fire we aren't? Or is he just the only sober person at a very expensive party? Let's peel back the layers and see if the floor under our feet is actually moving. Is the market getting crazier or did the floor move? That's the big question. Since 1970, the Buffett Indicator has been on what analysts call a stairway to heaven. It makes it look like the market is always getting more expensive. But we have to ask, has the normal baseline shifted forever? Back in the good old days, we're talking 1950 all the way to 1995, the stock market was what you'd call a cheap date. The indicator generally ran in a low band between 40% and 80%. If it hit 100%, everyone started looking for the exit. But since 2009, something fundamentally changed. Massive structural shifts from central bank policies to the way we value technology have pushed that normal baseline higher and higher. Historically, this ratio was great at flagging big regime shifts. At the 1982 trough, the indicator hit a tiny 32%. Then we saw the 2000 dot-com peak at roughly 143%, followed by the 2021 surge. But today's reading of 219.4% isn't just a peak, it's a mountain range. The fair value line is stuck on the ground floor while the market is riding a high-speed escalator into the clouds. Are we living in a new reality, or is this just the longest-running bubble in human history? Let's crack open the hood and see how this doomsday number is actually put together. It sounds simple, market cap divided by GDP. But here's the catch. Different media outlets and data platforms use different rulers. It's like two people measuring the same fish. One uses a wooden ruler, the other uses a piece of rubber, which is why you see different numbers in the headlines. If you crunch the rawest data using a Wilshire 5000 market cap of $68.21 trillion divided by a U.S. nominal GDP of $30.62 trillion, you actually get a reading of 222.7%. However, for our analysis throughout this video, we are adopting the figure of 219.4% from GuruFocus.com. Why? Because they provide deep, consistent monthly historical data, which is essential for us to see the long-term trends we're about to explore. By using a consistent baseline, we ensure that our comparison between 1970 and 2026 is actually apples to apples. Let's see why this specific math is causing so much debate among the pros. So, is the indicator actually broken, or are we just trying to weigh a digital cloud with a rusty old-school scale? The first big distortion? Globalization. In the 80s, less than 20% of S&P revenue came from overseas. Today, it's 41%. Think of the US economy as a small wooden pot, and the S&P 500 as a massive apple tree. Nearly half the branches are hanging over the fence into international waters. The Buffett Indicator measures the weight of the entire tree, but only counts the size of the local pot. It makes the market look way heavier than it actually is. Next, intangible assets. Research shows that in 1975, 83% of corporate wealth was stuff, factories and tractors. But in the 2020s, that ratio has cratered to just 10%. In other words, intangible value, things like software, patents, and brand power, has exploded from 17% to 90% of the market's total value. These intangibles can support a much higher market cap per dollar of GDP than a fleet of tractors ever could. Then there's the profit surge. Since 2000, margins have gone vertical. Why? Lower taxes, lower headcount, and massive tech leverage. The cost to add one more user to Meta or Google is basically zero. That creates profit levels that were mathematically impossible in 1960. Finally, meet the incredible shrinking pizza, aka share buybacks. When a company buys its own stock, it's just cutting the same pizza into fewer, larger slices. The price per slice, your stock price, goes up, even if the total amount of pizza hasn't changed an inch. For traditional value investors, a ratio this high isn't just a warning, it's a screaming siren of speculative excess. Warren Buffett himself, in his famous 2001 Fortune essay, didn't mince words when he said, "If the ratio approaches 200%, you are playing with fire." Under that classic school of thought, the US market is priced for a catastrophic reversion to the mean. To get back to reality, we'd be looking at a crash of over 50% just to realign stock prices with economic output. But that lens ignores a tectonic shift, the Magnificent Seven. These seven giants alone are worth over $21 trillion. That's 32% of the entire US stock market, a figure that practically rivals the GDP of the entire United States. M7 are transnational superpowers that distort our local math. The value of these seven giants is fully packed into US indices, our numerator, but a massive chunk of their revenue comes from international markets. That means they are contributing to foreign GDPs rather than the US GDP, which is our denominator. So let's try an experiment. What happens if we strip the M7 out and look at the S&P 493 on its own? Time for the audit. For the numerator, we strip the M7's 21 trillion from the market cap. Then the denominator, the US GDP minus the M7's value added. We estimate their US-specific revenue from 2025 filings and geographic data, which comes out to about $1.165 trillion. Following the BEA's standard for tech, we apply a 60% value-added multiplier to their domestic sales. This ensures we're only removing their actual economic footprint, not just raw revenue. The result? The Buffett Indicator for the S&P 493 drops to 155.8%. Here's the surprise. Even without big tech, the market is still expensive by historical standards. AI hype isn't the only driver. Globalization and fat profit margins are pushing the floor higher across the board. So is this a bubble about to pop, or has the baseline simply evolved? Let's find out. To find the truth, we have to fix the denominator mismatch. Right now, we're mostly comparing a global-facing market cap to local US GDP. But what happens if we do a true apples-to-apples comparison? We're going to look at this in two steps. First, by estimating the US local Buffett Indicator to see how it stacks up against history, and then by comparing it to the global Buffett Indicator. Since we know about 41% of US corporate profits actually come from overseas, we strip out that 41% of foreign profit to find the domestic Buffett Indicator. The number drops from a scary 220% to 131%. That's still historically high, but it suggests half of this excess is structural globalization, not just speculative mania. But to get the full story, we have to look at the big picture of the entire world. Welcome back to the neighborhood orchard. The U.S. sequoia towers over its pot, branches stretching far into international waters. All around it are the global trees, Europe, Japan, and emerging markets. You can see global GDP written on the ground where all these pots are sitting, including the US one. Meanwhile, the global Buffett Indicator sits between 112% and 130%. Our local 131% is right at the top of that global range. The takeaway? This isn't just a US story. Asset inflation is a worldwide phenomenon.
Now, let's go back to that S&P 493 we discussed earlier. The market minus the tech giants sits at 155.8%. Compare that to the global Buffett indicator of 113% to 120%, and you see the S&P 493 is still noticeably higher than the global benchmark. This means the broader US market is definitely still carrying a premium. Finally, since we've established there's been a massive structural shift in the US economy and corporate landscape, we have to ask, how far have we actually drifted from the long-term trend?
To really understand if this matters, we have to talk about detrending. If you look at a standard chart, the trend line is constantly rising. That's the new normal trend for the Buffett indicator. If you only look at the raw number, it's always going to look like it's either crashing or exploding. But when we use the detrended version, we can see how far we've actually drifted from that long-run upward path. Our data shows we are currently at plus 2.97 standard deviations above that trend line. In the world of statistics, that's not just high, it's practically off the map. By using these four lenses together, the global, the local, the S&P 493, and detrending, we get a much more accurate signal of exactly what to expect over the next decade.
The indicator isn't a crystal ball, but it is a dimmer switch for future returns. So does it still matter? Yes. At 219.4%, the hand is turning the light down. It's not pitch black, that would be a crash. It's just going to be much harder to see your way to big profits in the coming decade. So how do you actually play this? Well, you've got two high-level playbooks here. First, there's the Warren Buffett route. Sit on your cash and wait for things to snap back to the average. As Buffett himself said at the 2025 Berkshire meeting, he doesn't have a crystal ball. It could happen next week, or it could be 5 years off, but as he put it, it won't be 50 years off. He's waiting for that mean reversion bust to arrive, and he's got the patience to let it take its time. But if you aren't ready to sit on the sidelines and miss the AI boom entirely, you can take a page from Howard Marks' memo. Something I touched on in my last video, Is AI a Bubble? His advice is simple. Don't go all in, but don't stay all out. Think of it like grabbing a quality umbrella. Instead of betting on the whole sky, focus on high-quality, cash-generating businesses, the kind of companies that stay dry even when the rest of the market is getting soaked. The bottom line? We probably need to recalibrate our expectations. The days of easy 10% annual gains are likely behind us for a while. Moving forward, we should be looking at real returns closer to the 0 to 4% range. It's not as flashy, but in this environment, it's the smart way to stay in the game. If you found this dive into the numbers helpful, go ahead and hit those like and subscribe buttons. And I want to hear from you. Where do you stand on the Buffett indicator? Is it a broken scale or a smoke alarm we shouldn't ignore? Drop your thoughts below. I read them all. See you again next time.